In this video, traders, we're going to look at the 5-period envelope trade. Hey guys, a very warm welcome to you. So this is a 5-period envelope trade. We can use this on major indices, we can use this on forex pairs, we can use this on stocks. Now basically what we need, or what I have in front of you on the screen now, is a 30-minute chart, and this one happens to be of the Dow. 30-minute chart, and I'll show you an example in a second in another currency pair, with what's called price envelopes on. So this could be envelopes in your package, could be price envelopes, could be moving average envelopes. The idea is the difference between an envelope and other bands is that this will stay at a fixed distance. So Bollinger bands work off standard deviation and will expand and contract accordingly. Keltner channels will do the same thing. They're based off ATR, so they'll expand and contract accordingly. Not so as aggressive as the Bollingers, but they'll still change in width. However, the price envelopes stay at a fixed percentage width. So they're based off a moving average, just like the Bollinger bands are, but there is a specific fixed percentage width outside of those that the envelopes will stay. So the settings we use are 5-period moving average. On the exponential settings, you've got it. If not, simple's fine. And the percentage bandwidths I've got at 0.4%. Now, how do I come up with those? The way I come up with that is I really want the bands from high to low to be approximately 1 daily ATR. So the average true range, or the most likely range, however you want to frame it, of the day of that market, those are the envelopes I want to use. So for the Dow, I know it's about 200 points. So I'm looking here, the high of the envelope is 24,732. I want the low to be around 532. It's around 535. That's close enough, right? That's 200 point range. That's my daily ATR. I've got on my daily chart, I checked the average true range, and I'm using that as a price envelope. If we look at USD JPY, same thing. I know the daily ATR happens to be 40 pips when I'm doing this video. So I look at the high, 80. I look at the low, I'm around 40. I'm not far off the mark, and the percentage for that would be 0.2. Now obviously you can use a formula for that. You can go and you can work out and say, hey, I want to see 40 pips. What is 40 pips as a percentage, expressed as a percentage of the current price? That's going to give you your percentage. That's the one you plug in to your settings on the indicator. So once they're in there, you know your band is wide as the daily ATR. Okay, good. We're all set up with that. 30-minute chart, candlestick, obviously. The idea of this trade is when price breaks out of the envelope, when it comes back in, we're trading in the direction against the initial move for a counter trend play back to the other side of the envelope. So when price breaks out, we don't take the, so for example, price will break out to the downside. Here we go here, for example. We're waiting for the first close back into the envelope. And yes, I think you can take this on gaps, because I think this is powerful on gaps as well, because don't forget, ATR is just the whole movement allows for gaps if you're using ATR. So I think you are quite within your rights to use it on gaps, and you're going to get those powerful trades. And the good thing about this trade is that, so if you're using gaps, that'll be your indices and your stocks, obviously forex on the weekend. But the good thing about this trade is that you're not getting into it until it starts to exhibit some counter trend movement. So for example, here on the Dow, on this candlestick, we close outside of the band, so we're ready now for the first close in. Second one closes outside, we're not on it yet. We'll get the close back in the band. Now we're long at this 653, and ultimately we're looking for a tag of the upper band the next, and this happens to be the next day, and we're coming out at 809. Now I think that's your ultimate target. Do I think you could have some exits in between? Yes, I do. I think you could say something like, hey, I'm going to take my risk off at a move back to the midpoint, if that seems fair, or the end of the day if we're trading a stock or an index. You know, I think that's fine. Stops wise, you want to use the distance between the extremes. So the extreme would be the low outside of the band, and the distance between there and there. So if we're long at 651, say, and our stop is here at the low was 569, we're probably going to have a few ticks over it. We're looking at about 100 pip stop, 100 tick stop on that. I'm talking about the Dow. But we're getting, you know, a decent target on that, aren't we? We're getting a decent move. So it's one of those where you can adjust it to suit. You know, if it's a really big candle, that signal candle like this one's reasonably big, you might just want to use half. You might just want to say, okay, well actually my stop is going to be just on that band as opposed to the extreme of the band. Most of the time, we'll look at some examples in a second, we're not going really far out of the band. It's normally just kissing above or below it, so you can use a stop at the band just below it and sort of drag it around there. Like I say, targets are the other extreme, or the midpoint, or trail, or use a multiple of your risk. So entry will be there, and we're out on this one. Next one, we've got another close here outside of the band, just about. Our entry would be here. Now, if we hadn't scaled some off as we came to the midpoint, this would probably be a loser later on in the day. We did have a chance where this came into profit, but again, you know, do you take it or do you not? It's entirely up to you. Are you looking for that home run? Are you placing it, excuse me, in the bigger picture of the daily chart? Or are you just looking for a scalp? Entirely up to you with your trading. So we've got a, you know, that could be a loser or a winner depending on how you look at it. Let's have a look quickly at USD JPY currency pairs before we kind of move on and end the video. This type of thing as well works well for news-based stuff because the bands are fixed. You're not getting the extreme with the Bollinger Band, which messes the whole thing up. Great one here, spiked out of the band. We're taking a short. It feels late, right? It feels late. I get it. I know I'm looking at this thinking, oh, it feels like I'm really late to the party. But the point is, you know, the rules are the rules, guys. If you want to modify them, then by all means, these are foundations for you to take bits that you like from the idea and bolt into your own strategy or discard. You know, that's the whole point. This is why I kind of research these myself. I look and say, could I implement that with the existing strategy that I know works well for me? Yes, okay. Excuse me, how do I do that? Okay, I'm going to do this and this. So textbook wise, you'll be taking the short here. What I won 10.54, and you'll be coming out of the tag of the lower band, which actually doesn't happen till right down here. In fact, you probably don't quite touch it at all. So technically, maybe you touch it there, maybe you don't. But I think even if you used a trailer, you'd come out when it's kind of going against you. But the point is, there's a lot of meat in that trade. It signified the reversal quite nicely. Yes, it's late in the move. I get that. I wouldn't be that comfortable taking it, but you get the point. Let's see if we've got another one here we can look at. Here would be a loser for you. You'd take a long here and you'd be coming out here, but the risk is reasonably quantified, so it's not the end of the world. There was another one I had for you guys which looks quite nice. So we can see exactly how these work when they're working nicely. The good thing is about if you get the bands right, you're going to stay out of these trending environments. You know, you don't want to be fading a counter trend move. That's the last thing you want to be doing. This one just about closes about of it, and maybe it doesn't. That's probably not a trigger. And one thing you can do as well, guys, is you can, if you find that you're getting too many signals, here's one here for us, a couple actually in a row. If you find you're getting too many signals, widen the bands a touch. They shouldn't be if you've got the daily ATR set right. If you're finding you're almost getting signals, by all means narrow them by a bit. You know, if we're talking 5-10 pips, you can play around with it. You've got one here that probably didn't quite close, did it? This one definitely did. Your next trade is going to be on the close below. This looks fair enough to me. So you're shorting at 109.60. Your stop's going to be above that high. Don't forget, you don't want to be on the high. You want to be a few ticks above because it may well probe. And this one rolls over quite nicely, and you've got all the time in the world to close that for a decent profit. That's looking not massive profit because of the environment they're in, but you're looking about 20 pips or so on that, a decent scalp trade on an intraday kind of basis, or you close out at the end of the day for whatever it gives you. The point is, it's a stretch spring. You know the deal, guys, with the mean reversion trades. In the right conditions, they're beautiful. In the wrong conditions, you get something, but you got to be quick. You got to grab it and move on. Extension, compression, out. Extension, compression, out. Range band environment, you can wait for the compression, the extension the other way. So you find the right conditions, volatile range, this will work perfectly. Trend, cautious, scalping only, normal range, again scaling some out but playing the odds of it working in your favor. So that's the 5-period envelope trade. Have a look at it, play around with it, let me know your thoughts in the comment section below. Whatever you're doing, keep the risk managed. See you next one. Goodbye.